This is a remastered replay of one of our most popular episodes. Enjoy.
The most storied and the most prestigious of the accelerators.
YC or Y Combinator.
People have asked me about my experience with YC. Is YC worth it?
The best accelerators can really have a huge positive impact, and maybe some of the worst accelerators can really be a little bit of a distraction and actually just waste some of your time.
You're listening to the Startup Podcast. This is an educational episode.
Hey, I'm Chris.
And I'm Yaniv. And on this episode, we're going to talk about startup accelerators. We have a lot of early stage founders listening to this podcast, and quite often we're asked whether they should apply to an accelerator, what the benefits are, and so on. So we thought we would cover it all in this episode. So first of all, let's jump in and talk about what is a startup accelerator and what are some of the more famous accelerators out there.
Yeah, there's a few famous accelerators. You might have heard of YC or Y Combinator. 500 startups, Techstars. These are probably the top three in terms of brand. There's just so many accelerators littered around the globe. They have various names, various value props, various differentiators. But in general, the high level idea is that you apply for the accelerator. You pitch your startup or your startup idea at a very, very early stage. Maybe it's just an idea. Maybe it's you got a prototype. Maybe you've just got a team. Maybe you've had a little bit of traction. The accelerator team evaluates the applications. They might even interview you. And at some point, they select a batch, a group of people to go through the accelerator. And the premise is that through this period of time, maybe 6, 8, 12 weeks, roughly speaking, the intention is that your startup goes through a program, essentially, of mentorship, guided development, co-working space. At the end is typically a demo day. And you're supposed to be shot out the other side, moving faster, better, and more successful than you were before you entered the accelerator.
I think it's worth understanding what's the difference between an accelerator and a VC firm. In one important sense, it's not different from an early stage venture capital firm, a seed firm, for example. They both evaluate different startups and then invest in some of them. So the way an accelerator works is in return for a bundle of intended benefits, you are giving away equity in your startup to the accelerator. And that is how accelerators make money. Like any other venture capital firm, they end up with a portfolio of equity in different startups. They hope some of them will become big winners, and that's how they make their money. How these things differ from a typical VC is, as you said, Chris, there tends to be a structured program. I think the classic length is 3 months. It can be 6 months, and it's nearly like a boot camp for your startup. And during that structured program, you're getting a number of intended benefits. The first is the structure itself, right? The fact that you have a kind of accountability, you get education, you get access to different resources. There's generally a mentoring and assistance component through that. And there's also the fact that generally when you go through a startup accelerator, you're part of what's usually called a batch. So there are a whole bunch of different companies that are admitted at the same time, again, like a boot camp, or you could even think of it as a type of mini MBA for your startup. And you get to network with those people. And if you talk to people who go through accelerators, or similarly to people who go through a high-end MBA, they will often talk about the people they met, the relationships they built, the network they created there as one of the biggest value adds. So when you think about a normal VC, the equation there is primarily what you are getting in return for the equity you give them is money. Secondarily, you're going to get mentoring, assistance, networking. A lot of VC firms offer that now. But with an accelerator, it's tipped the other way. Most accelerators do give you some amount of money, but at quite a low valuation. What they're primarily giving you is the mentoring, the assistance, the networking, and things like that. So given that, you're really giving away equity in return for those other intended benefits.
Now, of course, just like VC firms or just like any program or company or institution in the world, these things are not all created equal, right? And so not all accelerators are great or amazing, and some accelerators stand out from the crowd as being, world-class and perhaps the best.
There are a few intended benefits of an accelerator. First is direct funding. That's the only one that is directly comparable to a VC firm. They will usually give you money. It's normally in the order of $100,000 to $200,000. So it's sort of like the size of a pre-seed investment. And if you actually look at the implied valuation in terms of how much your company is worth based on the amount of equity that you need to give away, which is normally in the order of 5 to 10% of the company to the accelerator. The valuation, the implied valuation is quite low. It's normally in the realm of $1 million, which is less than most reasonably promising startups can get directly from seed investors. That's one bit of value. Beyond that direct funding, there are a number of other benefits or purported benefits that you get. The first is mentoring and assistance. There will be generally partners or other folks within the accelerator who are there to help you. There might be classes as well as office hours where you can ask questions and things like that. If you get good advice, I think most founders know good advice is priceless. But the quality of this is highly variable between accelerators or even within the same accelerator. The next intended benefit is networking. You get access to a cohort of people like an MBA who are going through the same thing as you at the same time. You can share war stories. You can get to know each other pretty well. And often those are relationships that become really sticky and cohesive. There are also often other group negotiated benefits. So, for example, accelerators will often provide access to discounted cloud services, SaaS, all sorts of things that are often expenses at a beginning of a startup that you can ill afford. And so, real discounts there can make a significant difference to your runway. So, that can be quite valuable. There is the alumni network, right? The fact there are people who've been through this before and often are favorably disposed either as angel investors or mentors, potential partners to folks who are coming through the same accelerator that they did. And then the final one is often the most important in some ways, or at least it used to be. And I think this is one that we can dive into a bit more, Chris, and discuss whether it's still relevant, which is credentialing. And what I mean by that is that the fact that you got into a startup accelerator, especially if it's a prestigious one, in itself sends a strong signal or is intended to send a signal to other investors, to other partners, to potential employees that this is a good startup, that it's in some sense been anointed by this accelerator, and therefore it is good. And you should be more favorably inclined to investing in them, to working for them, to partnering with them. Especially on the investment side, that can be really valuable and in some cases can make up for the equity dilution that you took from joining the accelerator itself. Closely associated with that, Chris, you mentioned the demo day. Again, I think this is a convention that comes from Y Combinator originally, which was and is the big daddy of accelerators. I would say it pretty much pioneered the accelerator format and is still considered the most prestigious one. At the end of the cohort, at the end of your 3 months, they get all of these investors who like YC because they value the credentialing of YC into a room. And you as a founder get to pitch to hundreds of investors all at once. And hopefully you're able to secure a better quality round, potentially a higher valuation, higher quality investors for less effort because of that credentialing and because of the opportunity to get in front of all of those people at once.
Demo day in some ways has become one of the most important parts of an accelerator, right? You talked about YC, which is the acronym for Y Combinator, the most prestigious and first major one of these things. It is the gold standard. Y Combinator's batches, their cohorts of startups, and their demo day is so frenetic now. There's so much energy and buzz around it. There are investors who are just like feeding at the YC trough, right? They're trying to invest in these batches of these startups even before demo day, or they're trying to get a glimpse into what's going to happen at demo day. And they all jump in a massive frenzy on demo day and shortly after demo day. And so at its peak and at its craziest, Y Combinator as the leading one of these accelerators can be really quite chaotic on one hand, but actually a massive accelerator for your business and can actually, at its worst, really drive valuations up into the stratosphere and add a lot of signaling to your startup and give you a lot of momentum coming out of that program.
So that's the intention of an accelerator. And we've talked about it from both points of view, from the business model of the accelerator itself, which is very much the same as an early stage VC, through to the intended benefits that are very much sold to startups as reasons to join an accelerator. So then the obvious question becomes, okay, I'm a founder of a startup or I'm involved in a startup. Should my startup apply to join an accelerator?
Let's continue discussing this after the break.
Listen up. I know a lot of you use dev agencies to help build your product. Problem is, a lot of those agencies suck. I've been looking for one I can really endorse, and I finally found one. Warp Development are the powerhouse behind countless successful startups and enterprises for over 22 years. They have 100 plus experts who don't just code, they solve business problems. From custom software to AI consulting, Warp delivers results that move your business forward. And they're in your time zone. They have offices in Australia, the United States, and South Africa, so you get local support with global expertise. Are you ready to build something that matters? Visit warpdevelopment.com, that's WARP development.com, and mention the Startup Podcast for a free consultation. Today's episode of the Startup Podcast is brought to you by .tech domains. One thing about starting your startup that should be easy but isn't is naming it. Why is it so hard? Because all the good .com domain names are taken, so you end up doing something silly like misspelling it or adding random prefixes or suffixes. No more. Your domain shows your focus and intent, so you should make it sharp, clean, and unmistakably tech with a .tech domain. Head to get.tech/TSP or a registrar like GoDaddy to grab your .tech domain today. That's www.get.tech/TSP for the Startup Podcast.
Okay, let's get back into it. There's two key things to have a think about. The first is, is your startup at the right stage? And Yaniv, you touched on a valuation there where they'll give you $100,000 or $200,000 for 5 to 10% of your company. You have to ask yourself, is that money plus those additional services right-sized for the stage that I'm at and the maturity that I'm at? Do I really need this kind of help? Am I at this stage of the journey, the startup journey? The other question is this the right accelerator for me to be joining? Because like any institution, like any venture fund, like any money, it's not all created equal. There are the winners, the excellent, world-class, best of the best of breed institutions that provide the very best of everything Yaniv just said. And then there are kind of the rest, the middle of the road, and perhaps even some of the worst accelerators out there. When you're trying to evaluate, should you join this particular accelerator, you want to be looking for the things that Yaniv touched on and asking yourself some hard questions. If the value is in the funding, well, how much funding are they giving you? And how big and successful are their demo days? Do really world-class VCs show up to those demo days? And do the startups that go through their program end up being invested in well? If you're ostensibly going in there for the mentoring, do they have world-class mentors? Are the people signed up to help these startups career advisors, academics who've never really built anything themselves? Or are they world-class names that have worked at world-class companies and themselves had some world-class outcomes? If the value you're focused on and looking at from the accelerator is around networking, does this accelerator have a powerful alumni program? Are there former startups that have gone through the program who you might want to lean on those founders and lean on those networks, and have they become angel investors themselves? And so is the networking opportunity real? And then, Yaniv, you talked about credentialing. Does this accelerator or the sponsor of this accelerator have a strong brand? Do they have real successful outcomes from prior cohorts? And so you need to be looking at this program with a little bit of skepticism, because there is a lot of accelerators out there that don't really deliver that full set of value that Yaniv talked about, and judge them on the strength of their funding, mentoring, networking, credentialing capabilities for your startup. If you're a first-time founder, you maybe are fresh out of school, you've never really done entrepreneurship, some of those bars can be a little lower. Maybe this can be just a great way to learn and network and socialize and get some of your early thinking about startups, test some of that in the real world. And so maybe your bar will be a little bit lower. But if you're a little further along in your career, you've had a startup or two, or you're wanting to get really serious about this, then you really need to set your bar pretty well and be pretty discerning about the accelerator that you choose to apply for and ultimately go through.
I think there's this spectrum based on A, the quality of the accelerator, and B, your level of potential gain as a startup from the accelerator. So starting at the lower left corner, the no-brainer, if you will, if you are an inexperienced founder with not much of a startup background, with no network, with difficulty accessing capital, and you can get into a top-notch accelerator program, then that's actually a really good deal, right? You get a little bit of money, maybe not the best valuation ever, and then you just get brought into this startup world full of people who know what they're talking about and other great founders who are going on similar journeys and all sorts of wonderful stuff. And that is just a really fantastic experience. And then right at the other end, if you are a very experienced team, you're a startup that has traction, that has access to funding, or perhaps doesn't even need funding, has all the funding it already needs. You're well networked, you know what you're doing, and then you get into a mediocre accelerator, then of course, that is a waste of your time and it's a waste of your equity, and you should by no means do it. And then, of course, you're in that messy middle where you really need to consider a more structured approach to deciding whether it is worth your while. And that's why we broke down before the different intended benefits of an accelerator. And you should, like with most things in life, if you're going to go for the accelerator, understand what it is that you're hoping to get out of it. Is it the funding? Is it specific mentoring and assistance from specific people who you know you will have access to as part of that accelerator? Is it the fact that you want to build your network, that you feel it's very important for you to build up a network with many other businesses, with many other founders? Is it that credentialing piece? Do you think that being part of this accelerator will allow you to raise capital that you need to raise that you would otherwise have much more difficulty raising, or that it will increase the valuation by an amount that more than compensates for the dilution you took from joining the accelerator? Actually stop and think. What are your gaps? What are the things that you need? Is this accelerator going to give them to you? And is it worth paying the equity that you are paying? Because that is how you pay. And it's very real. The dilution is very real. Are you going to get enough back in order for it to be worth that cost? And make that objective decision. And of course, the other thing to consider here is these accelerators can be quite selective. So spend some time thinking about it before you apply, but then realize that you're quite likely not to get in anyway. And once you've applied, you're not actually committed to joining the accelerator in most cases. Check carefully though first. So leave the really heavy duty decision making to once you've actually been accepted. Because I've seen a lot of people spend a lot of time agonizing over whether to apply for an accelerator, only to finally decide that they would like to join the accelerator and of course get rejected then, which is a big waste of time and a bit of an emotional roller coaster that they just didn't need.
I think, Yaniv, you did an excellent job of describing this chart, right? On the bottom left, where it's a slam dunk, you're an inexperienced founder and it's an amazing accelerator, then absolutely you want to join. And on the other side, well, you're an awesome founder and it's a pretty crappy accelerator, then you absolutely don't want to join. I think actually in the middle there, what would be most effective actually for a lot of founders and startups is actually finding one or two great advisors to plug the holes in your team or in your startup. So if you have a solid sense of what you're doing, or a startup that's got quite a little bit of traction, or you're a founder with a little bit of experience, but there are some clear gaps in what you need to get through the next hurdle or win the next opportunity or make the next breakthrough, then an accelerator can really just be more distracting than it's worth. As I said, you go through product week and go to market week and growth week and support week, and it's like your startup is just not needing to go through these random weeks. You may have some very specific things you need to achieve this cycle, maybe this quarter or this month or this week. And it might be more useful to have a stateful new employee, part-time employee, advisor, someone that is focused on the thing your startup actually needs, rather than a more of an MBA or a kind of a startup school, a generalist school to get you on your way.
Yeah, that's right. It's worth remembering that there are these other options. Another option is picking the right angel investors who will invest in your company at its true valuation rather than the fixed valuation of the accelerator. And a good angel will give you a lot of access that you might get through an accelerator as well. All the best .coms are taken or crazily overpriced, so you settle on a workaround domain for your website. Don't compromise. Get a clean, sharp .tech domain that instantly says, this is a tech startup. Grab yours at get.tech/TSP for the Startup Podcast or via domain registrars like GoDaddy. Looking for a tech partner to scale your business? Here's one I can personally endorse, Warp Development. With 22 years of experience and 100 plus experts, they deliver custom software and AI solutions that drive results. Visit warpdevelopment.com and mention the Startup Podcast for a free consultation. As a number of our listeners know, because they've asked about it, my startup and I went through the Y Combinator program at the beginning of this year. And people have asked me about my experience with YC, is YC worth it, and so on. The interesting thing is, our startup, Circular, I guess falls into that, not at either end of that chart that I just mentioned, Chris, neither no-brainer nor slam dunk. And this might sound slightly arrogant, but it's the reality. We are a startup that has a large co-founding team of experienced operators. We'd already raised a significant size pre-seed round. We kind of knew what we were doing. We had good networks. So there wasn't this pressing need to be accelerated. On the other hand, we got into Y Combinator, which is the best of the accelerators. I think it's generally considered, or at least the most storied and the most prestigious of the accelerators. And so we actually, when we did get in, we agonized over it. Is it worth the dilution, given that we kind of mostly know what we're doing, to join Y Combinator? But ultimately, we did decide to do it. My experience was a mixed one, I would say. And I don't know if anybody's here listening from Y Combinator, but I think it was a bit of a unique time, partly because it was during COVID, and this was the only fully remote batch that Y Combinator has ever run. They've actually gone back to partially in person. And because it was fully remote, and because I think the largest cohort, they hadn't done it quite like this before, I do think that the networking really fell flat for me in a way that I was quite disappointed by. We didn't get to meet people in person. I think the opportunities for interacting with fellow founders were not particularly well thought out. And so I didn't get the benefit that I'd hoped to from being amongst the founders of many of the other great startups out there that I'd hoped to. I think similarly for some of the courses and the classes, there was an unfortunate lack of consideration for different time zones that people were in. And so for me, being in Australia, nearly all of the classes were at like 3 a.m. And so I couldn't attend many of them because, as YC themselves said, it's really important to manage your energy, get enough sleep and whatnot. And that was actually not compatible with the schedule and the time zones that were available. But those are quite personal things. I think the things that did work really well for me were, first of all, the assistance we got from the partners who are very experienced startup operators and investors. For example, we had Tom Blomfield, who's the founder of Monzo Bank, which is a unicorn. The thing you get is these one-on-one office hours, access to really experienced people that you just wouldn't have access to otherwise. It's not that we got copious amounts of advice. It wasn't just like hundreds of nuggets of great advice that we really needed. What we got through the course of the 3 months is probably 2 or 3 bits of advice that really changed our perspective. You might say, well, just 2 or 3 bits of advice for 7% of your company doesn't sound like a great deal. But what you need to remember is these bits of advice potentially have a massive positive effect on the future trajectory of our company, right? You're dealing with risk, and just being able to make those right decisions, getting that really wise counsel when you need it, can be absolutely trajectory altering for your company. So I actually think that was in some sense quite a good value for us to say, you're talking to people who can see around corners for you, who've been there and done that in a way that very few people in the world have. And you get to ask them any questions you want about your business. That's valuable. And then the other piece, and this is, somewhat mundane, but true. It's impossible to establish for sure in the absence of counterfactuals, but the credentialing piece allowed us to raise a pretty good round at a pretty good valuation. And although the investors did not come from demo day, I strongly suspect that the fact that we were a YC credentialed company made it easier for us to get the initial meetings and probably made it a bit easier to close on the terms and at the valuation that we wanted. So overall, I found YC to be a mildly positive experience. But I would say for a majority of founders, I would actually recommend it fairly strongly. However, note that the likelihood of getting in is quite low. And now that it's not fully remote, you get to do it at least partly in person, but that means that you'll need to relocate to San Francisco for at least part of the time. People with family commitments may not be able to do that. So it is worth considering whether it fits into your actual personal life, but it is a really excellent program overall.
Yeah, it's actually very interesting because, as much as Silicon Valley is really a very open place or even an open philosophy, we've talked about pay it forward and so on in previous episodes. When you go to the Valley, or at least when I went to the Valley, everyone embraced people with open arms and this kind of thing. But there are a few, let's call them fast tracks or on-ramps that help you to really succeed with your startup in the Valley or in the startup ecosystem broadly. I think the first one is to have a successful startup. So somebody like Mark Zuckerberg, who came in with Facebook having a great deal of momentum behind it, I think he was kind of given the benefit of the doubt and was embraced that way. But then someone like Sean Parker took him under his wing and helped him raise money at many, many multiples. I think being part of a great school like Stanford in particular is a great on-ramp. It's a great inroad because Stanford has really great roots and deep connections into Silicon Valley. And actually, the way they teach and the way they think about the world is very Silicon Valley-esque. An accelerator like YC is one of those on-ramps, Techstars, 500 Startups, and so on. It is a way to, as you said, credential you, but also to introduce you to the right people and pathways inside Silicon Valley. And then the other one that comes to mind is being a blogger or an influencer in some way, where I saw a lot of journalists at the tech crunches of the world who maybe weren't credible in other ways, but by nature of them reviewing the ecosystem, they were invited into a lot of rooms and places that they wouldn't have ordinarily been invited to. And so there are other ways, there are other pathways, on ramps, fast tracks, but accelerators like YC are one of those things that can really make or break or accelerate your introduction to that community, not just for your startup, but for yourself in a way that's very, very powerful.
So, like I said, YC is quite selective. In general, it's probably worth applying for. Don't agonize over it, like I said, because I think the odds of even a great company getting in are quite low. Like with any highly selective process, honestly, I think there's a huge amount of luck involved. If you don't get in, that hardly means that your startup is not a good idea or that you're not good. It's just a bit of a luck element there. But then it's a question of other accelerators. And I don't know about you, Chris. I won't present myself as an expert about which accelerators you recommend, which you don't. I think it's more a question of doing your own fact checking, right? There's certainly accelerators that are better known. Like you mentioned, Techstars and 500 Startups are two of the other big ones. There are local accelerators all over the world. What I would recommend doing, honestly, is finding alumni of that accelerator and getting a good understanding from people who've been through it, what their experience was like, and then mapping that to your needs. I'll keep coming back to that. There are a whole bunch of potential benefits of an accelerator. Which are the ones that are important to you? Is it networking? Is it funding? Is it mentoring? Decide and then see by talking to people who've been through it, do those benefits actually seem to accrue to people who go through that accelerator? And that is really how I'd recommend deciding whether it's worth applying to these things.
But hey, Yaniv, if the ultimate benefit for you at YC was just a couple of great nuggets that change the trajectory of your company, maybe people just have to listen to the startup podcast and they'll be fine.
That's right. Do we have an announcement? Are we starting our own accelerator program, Chris?
I feel like people should register to give us equity in their companies in return for being a loyal listener of the startup podcast.
Absolutely. We will take equity from anyone who wants to give it to us. We got a few questions about accelerators for this podcast. Now, I'll read them out as a way of acknowledging some of the inspiration for this. Some of these are questions that we've already answered. In cases where there's a bit more that we can add, we will answer those too. So the first question was from Madhu. Is YC worth it? What accelerators do you recommend? When is a good time for an accelerator and when not to join? I think all those questions are ones that we've covered fairly well. The fourth question Madhu asks is, are there equity-free accelerators out there? Again, I do not have an encyclopedic knowledge. I suspect the answer is no. And even if that's not the case, my second answer to that would be you get what you pay for. Accelerators are there to provide value and they are businesses. They need to get something in exchange for the value that they provide. And if it's not equity, it will be money. And frankly, I can't imagine an accelerator that takes cash from cash-strapped startups being reputable in any way. There are perhaps some government-run accelerators that are equity-free. I suspect that they're not of a particularly high quality if they do exist, though.
Yeah, they're probably equity-free and quality-free.
That's right.
I think the sponsoring thought behind that question, equity-free accelerator, is probably you're thinking about it the wrong way, Madhu. You sell or give equity in your business in order to increase the value of that equity, increase the value of that overall pie. And so it looks like you're trying to get away with something there, trying to get a different approach. And that feels like the wrong mindset. The accelerator should have skin in the game in terms of increasing the quality of the startups they select, taking a bit of equity, and then participating in the upside.
The next question is from Bill. He asks, would like to know what you think the biggest value add for Circular would be? Money, learning, network, other? I think I answered that with sharing my YC experience. I do think it was advice, which is a type of learning, I suppose, and then that credentialing. And I think there's no doubt that being able to say that you're a YC startup, it still opens doors. There's sort of inside chat on TechCrunch and stuff like that, that YC isn't the valuable credential it once was. It's quite possibly the case it's not as valuable as it was, but it is still certainly valuable. It's a brand that people recognize. It opens doors. And so I think that is really important. The third question is from John. Is it just a way for them, I think this means the accelerator operators, to preserve the cash they are investing and washing that through their own services to retain margin? So if I understand this question correctly, John is asking, in a sense, what's in it for the companies operating the accelerators? Are they just trying to get the money back that they put in through offering services to their startups? The answer is generally no. Again, I think it's a question of being reputable. I think any cynical fever dream that you can imagine is probably validated in some less reputable corner of the startup world. I'm sure there are accelerators who basically just sign up companies in order to be able to sell them stuff. But that's certainly not the case with the reputable ones. Whether you think it's a good deal or not, I think it is a fairly straightforward and honest transaction, which is equity in return for a bundle of services. And the incentives, once you're on board, are reasonably well aligned, like they are with most early investors, which is they want you to grow and succeed. So they're not going to get in the way of that. The way the Y Combinators, the Techstars of the world make money is to have asymmetric outcomes, to have some of the companies that they own 7% of become worth $10 billion. And so they are incentivized to help you succeed. Maybe not to bend over backwards, but certainly not to get in your way.
I want to talk a little bit about the potential for bad actors here, because I have seen situations where there are these hybrid approaches. There's firms that are not quite investors, not quite accelerators, but there may be like service providers that provide you a little bit of money, but a lot of services, and they're charging you some amorphous number for those services and taking some chunk of equity in your company. But they don't offer the program of an accelerator. They don't offer the demo day, the mentors, the alumni network. They're just kind of like an agency where they take a big equity stake in your business. And I want to caution that you watch out for that. When you raise money from a VC, you should be getting capital, and that capital should be properly valued or properly value your startup. And it should not be diluted by, oh, we'll also give you all of these services in kind or in contra, or like all these partnership things. It should be capital from a VC, and everything else is a bonus. Their network, their relationships, their advice, their partnership, they're sitting on your board and so on. And when you go to an accelerator, you get a chunk of change and an entire accelerator program with the key characteristics of the demo day and the mentorship and the program, the alumni network, and so on. And be careful about organizations that are trying to conflate and confuse these things and not give you a clean transaction, because I do think there are a number of these hybrid programs that can get wrapped around the axle or wrap you around the axle and have suboptimal outcomes.
Yeah, it's funny. I know sometimes as a guilty pleasure, I watch the Shark Tank or Dragon's Den, the British version. And, the investors there are always like, when I invest in you, I pay below the fair valuation because you're getting fucking Mark Cuban or whatever. And that is a value add. Okay. So that is exactly the sort of behavior that in the real world, we want you to watch out for. If you're getting an investor, that investor should be paying you the fair valuation, and then they should be working for you, in a sense, for free to help you maximize the value of their investment. Don't let them screw you around with this sort of, I'm amazing and you should give me free equity. An accelerator program needs to be a program. It needs to have a clear value add, and therefore you should be going to them as a service provider first and as an investor second, not the other way around. And I think you're 100% right, Chris. When investors try to pretend to be service providers so they can rip you off, then that is ultimately disreputable behavior. No diss to Mark Cuban, by the way. Love you, Mark.
Yeah, just in case Mark is listening to the show. I think there are all sorts of these shady, weird, and wonderful mixed things, and they generally tend to be more trouble than they're worth. So yeah, do watch out for that, and do a serious amount of diligence in whoever is investing in you or whatever accelerator you're joining. I have a little bit of skepticism about a lot of different program types. I'm on the record on LinkedIn and other channels talking about how some of the activities that the Australian government, for example, engages in are actually more dilutive and distracting than helpful. And there are these programs and grants and concierges and entrepreneurial programs that are all very well meaning and all on the face of them seem really wonderful. but they're really often very distracting. The entrepreneur, the founder, spends a lot of time trying to get acknowledgement or acceptance by a government program instead of spending their time getting validation from the only thing that matters, which is customers and users. The large body of low-rate accelerators out there are part of that problem. They distract the founder. They create a lot of applications and a lot of anxiety and a lot of 6, 12, 18 weeks of engagement in this thing that doesn't really add a lot of value. And so really choose your accelerator wisely as you'd choose an employee, as wisely as you choose your next feature, as wisely as you choose your launch market or your next market to go into. Each of these decisions needs to be done with a great deal of care and diligence and strategery to make sure that you're making the right choice for your startup at each step.
Your attention as a founder is one of the most valuable resources, or perhaps the most valuable resource as a startup, so don't let yourself get distracted. Now, I mentioned one of the most valuable things that I got from Y Combinator is a couple of nuggets of really valuable advice. And Chris, you said, well, there are other sources for that type of advice, and perhaps you can bring in some advisors. Now, I was wondering if you knew of any great advisors who might be able to help companies if they need some of those nuggets.
I wouldn't know what you're talking about, Yaniv. That's right. I have carved out some time to be an advisor for a small handful of startups. I'm not right for everyone, but if you are a startup that knows roughly what you're doing and has just a few key blind spots and needs some concerted, direct, and focused advice over a sustained period of time, then that is definitely what I do. So you can learn more about that at chrissard.com/advisory.
We're getting pretty damn good at these segues.
Yeah, I think the audience has no idea what we're doing. It's very, very ninja-like, stealthy.
The other thing is, don't forget the Startup Podcast is powered by you, our wonderful listeners. We get such a kick out of people reaching out to us. Please rate us on Spotify, Apple Podcasts, leave us a written review.
And don't forget to share us with your friends on social media.
Okay, Chris, thanks for that. Have a good week.
All right, catch you in the next one.
Today's episode of the Startup Podcast was brought to you by .tech domains. Naming your startup should be easy, but it isn't because all the good .com names are taken or wildly overpriced. No more. You don't have to compromise. Your domain shows your focus and intent, so make it sharp, clean, and unmistakably tech with a .tech domain. How do you do that? Head to www.get.tech/TSP or a registrar like GoDaddy and grab your .tech domain today. Get.tech/TSP for the Startup Podcast so they know you came from us. This episode of the Startup Podcast was brought to you by Warp Development. I know a lot of you rely on dev agencies to help build your product. Problem is, a lot of these agencies suck. Ask me how I know. I've been looking for one that I can really endorse, and I have finally found one. Warp Development are the powerhouse behind countless successful startups and enterprises for over 22 years. They have over 100 experts who don't just code, they solve business problems alongside you. From custom software to AI consulting, Warp Development delivers results that move your business forward. And they're in your time zone. They have offices in Australia, the United States, and South Africa, so you get local support with global expertise. Are you ready to build something that matters? Visit warpdevelopment.com, that's WARP development.com, and mention the Startup Podcast for a free consultation.